Let's take a look at the company. Novavax had some very important news today. We'll definitely look at the report. I'll make sure to tell you about these news, what's happening here. We'll also touch on the volatility, which has risen significantly. Let's look at forecasts, what the market tells us. We'll also touch on the 3D volatility. Let's start from the very beginning why I'm even doing a review of this company. It's related to the fact that in this video I talked in detail about 5 stocks with very high growth potential. Let's look at a small excerpt from this video. The Novavax stock in 5th place has 40% of its shares in uncovered sales. For example, let's calculate the potential income. If we buy, for example, 10 call options for $60 each, and if the stock returns, and as we can see, one of these stocks was Novavax. I showed a very interesting strategy there. I also discussed buying options for January 2025, and now we can see how much these options cost. At the moment, this option costs $267, so the growth is actually fourfold. This is very serious. Again, I absolutely did a review of this company for a reason. You can watch this video. It was recorded 2 months ago. Everything is as open as possible. Again, the options market and the derivatives market sent us very important signals. Back then, the stock was worth $5, and now it's already worth twice as much. That's $10. And based on the volatility, which I'll definitely show today, as well as the volume of options trading, which I'll also show today, I made such an assumption. As we can see, the stock has doubled. Now let's see what led to such growth. The first company released a report, which is available on their official website. You can check it out. I carefully analyzed this report. In reality, there's nothing interesting here. The company is still unprofitable. I won't waste time. Let's immediately move on to the news that really affected the market. Novavax stock doubles on $1.2 billion Sanofi deal for COVID-19. Flu vaccines, Novavax shares more than doubled in intraday trading Friday, as it announced a $1.2 billion deal to license its vaccine technology to Sanofi. Novavax will co-commercialize its COVID-19 vaccine with the French drug maker, along with developing others like a combination COVID-19 and flu vaccine. The vaccine maker also announced first-quarter results that included a wider-than-expected net loss. Sanofi to pay Novavax up to $1.2 billion to license vaccine tech. Co-develop new products. Novavax agreed to license its vaccine technology for COVID-19 and other possible future vaccines to Sanofi, as well as co-develop a combination vaccine designed to prevent both COVID-19 and the flu. Sanofi agreed to pay Novavax $500 million upfront, with another $700 million in possible payments depending on developmental and regulatory milestones. Novavax reported revenue for the first quarter of $93.9 million, shy of the $101.3 million analysts expected, according to estimates compiled. Novavax posted a loss of $147.6 million or $1.05 5 share, wider than the loss of $127.4 million or 90 cents per share that analysts projected. Also, we shouldn't forget that there was a short squeeze happening simultaneously. Again, in the previous video, that's exactly what I did, reviewing the most shorted stocks, and Novavax was among them. And of course, it has a huge potential for short squeeze, which has partially materialized. If we look, for example, at the morning trading, we see a very significant growth. Most likely, this is where the shorts were covered. As we see, after the rise, the company grew by another 100%. And perhaps some margin call happened here. I can easily assume that. And as we see, after that, the company stabilized and is practically at the same place around $10. So why $10? Now I'll tell you in detail about this situation. To understand, we need to turn to the derivatives market, to the options market. As we see, the volatility now exceeds 300% at the nearest strike, reaching unprecedented levels, my friends. I've seen volatility reaching 500 to 600%. It was with GameStop and AMC, but anyway, this is anomalous volatility. You've probably never seen and won't see anything like it. Moreover, on other strikes, volatility reaches 200%. The question is, how can one effectively profit from this? But first, let's look at the volatility smile. What's happening here? As we can see, volatility has increased, with volatility rising both towards stock increases and decreases. Now let's look at historical and implied volatility. Actually, historical volatility is the dashed line, while the white line is implied volatility. And as we can see, implied volatility is below its historical values. But I'm telling you, most likely, the chart hasn't updated yet. I'm trying to tell you as quickly and as possible. This chart hasn't updated, of course. Implied volatility, that is, the white line, will be significantly higher than its historical values tomorrow. And I always tell you about this. Look at the logic of making real money here. Since no one can predict price movements absolutely, neither I nor the funds, you need to use a different logic. That is, look from a completely different perspective. And my favorite growth strategy is the return of implied volatility to its historical values. We have volatility as a certain landmark, and implied volatility will always strive for this landmark. And look, this literally would have happened yesterday. It could have been said that volatility has been low for a long time. Today we return to our historical values. And again, you could have made money on this. In addition to the strategy I talked about in this video, you could have devised a completely different strategy. Let me show you. Of course, this strategy is not very effective now because volatility has already increased, but if we assume that we still don't know what movement will occur, then we simply rely on historical volatility, then we can build. Artificial intelligence will suggest to us which strategy to choose, and as we can see, we are offered to buy 4 call options with a strike of $5.50. 1 put option with a strike of $7.50. Buy a call option with a strike of $8.50. Buy a put option with a strike of $8.50. This is a complex strategy, but it's pointless to apply it now because the stock has already risen significantly. I'm just showing how you can play the increase in volatility, and artificial intelligence, of course, helps us in such moments. But again, I never advocate the use of artificial intelligence or bloggers or bots. You need to think with your own head. Only then can you truly make money. Let's look at the very main indicator, which is trading volume. And as we can see, a very large trading volume is concentrated around the $10 level. This is for call options and put options. Very, very large volumes. Also for put options, very large volumes are concentrated around the $9.59, $7.50 5. I also want to draw your attention to the expiration dates. That is May 10th, which is today. And as we can see, very, very large volumes are concentrated today for put options. That is, at the opening, when the market opened, when the stock rose so sharply, someone thought, I'm sure these are some newcomers. Buying put options hoping that the stock will return today, for example, to $6 or $5 and they will be able to make a lot of money. But they were wrong. As we can see, the stock became stagnant. And my friends, everyone who bought these options today, because obviously they were bought today, because there were no such volumes here yesterday and couldn't be. Therefore, everyone who bought these options simply lost money. Especially, how could you buy options at such high volatility? My friends, this goes against any rules. If you understand even a little about stock markets and derivatives, you should never buy options, especially near-term options, in a highly volatile market. High volatility combined with a close expiration date guarantees losses for option buyers. This is something everyone should remember. It's better to do nothing than to buy options. Because, as we can see, in this case, everyone lost money on this deal, but the circumstances are even worse, as I'm saying. Now, you need to understand how market makers operate. Yes, it's complicated, but I'll try to explain it to you. If you have questions, write them in the comments. So let's now analyze the put of options. I often analyze how market makers deal with options. Now we'll delve into the put of options. When investors buy options, as we see today, they've bought a lot of options. What happens in the market? At this moment, I'll thoroughly describe how market makers are obliged to sell options. And now he faces a potential loss if the stock falls. That is, if the stock starts to drop, the market maker starts losing money. And therefore, to hedge, the market maker uses a delta-neutral hedging strategy. The market maker must sell as many shares as equals the delta. That is, when he sells put options, he must sell shares. So to hedge their risks from falling stocks, they take a short position on these stocks. That is, if the stock starts to fall, their hedge will bring them money. And consequently, what do we get from this? Someone today bought a huge volume of put options that will be closed today. The market maker hedged this entire volume by selling shares. As we can see at the moment, the stock has dropped slightly, partly because market makers are pushing down the stock by selling it short to hedge their sold options. And what will happen if suddenly the stock doesn't drop below $10 or $9? I'm talking about these huge walls where it's stuck between $9 and $8. Here we will pay attention to these huge, unbreakable walls. So what happens next? As soon as all these options expire today, the market maker will be obliged to close all the accumulated hedge. That is, all the shares he sold to hedge the sold put options, he must buy back. That is, pushing the stock up can literally start a spiral. That is, market makers will literally start buying back all the shares they sold earlier because the hedge is no longer needed. Also, we have a very, very large volume of shorted stocks at the moment, and therefore I fully admit that the stock may rise further. Again, the point here is not that the stock has become profitable or successful. No, in my opinion, the stock is definitely incurring losses, and this is bad, undoubtedly a negative for the stock. But here, it might purely be a technical aspect. Market makers, along with those who shorted this stock, are obligated to buy the stock. And there might be a technical moment when the stock starts rising higher and higher. Who will stop it? Roll. And how it will turn out? It's hard for me to predict. The situation at the moment is fluid. Also, I want to show you the market forecast, what the market predicts for the middle. And as we can see, it's a very big forecast that the stock will be trading between $8 to $9 over the month. So the market says most likely we'll see some down movement, but again, during technical events when market makers close positions, when short positions are covered, I wouldn't pay too much attention to these data because these are all data based on absolutely stable market conditions. When nothing is happening and when some actions occur, naturally there's no point in focusing on that. So to stay fully informed, watch my previous video where I talked about this stock and why it had huge growth potential and why it materialized. In the future, I'll be recording such videos again, but most importantly, it to happen very soon. When I start building a portfolio from scratch, that is, my task will be to form an entirely new portfolio. We will buy stocks. I will tell you which stocks I am buying and why, what logic I am using. I will record all of this in a spreadsheet. It will all be distributed completely free of charge, and anyone can come and see it anytime. No other bloggers provide this. At least I very rarely see such things being offered for free. Usually they ask for some money for it. And also take a look at this video of mine. There I talk about the parameters on which my new portfolio will be formed, the logic of managing positions, and why I will do it this way. Good luck to everyone.